Intermediate goods growth by 3.3%. Capital goods, well, flat, no growth at all, 0.3% growth. But that has been contracting for some time now. So even this is not terribly bad news. I think last month we got a 2.3% positive on capital goods. Now it is 0.3. This is anyway a lumpy figure. So on a 3-month basis, we are not getting more than 1% growth in capital goods. The October industrial growth has been revised to minus 1.6 from minus 1.8, if that is any consolation for any of you. So that really is the story. November industrial growth coming in at minus 2.1. The positive, let me say that first, just at least for our satisfaction, electricity 6.3% and mining 1%. Otherwise, manufacturing is minus 3.5%. Within manufacturing, you have intermediate goods growing at 3.3%, capital goods at 0.3%, and basic goods at 0.7%. That's the growth sectors. The negative sectors are basically consumer goods, which have again contracted by 8.7%, and within that consumer durables by a whopping 21.5%. Aditi Nair of ICRA is also joining in. Aditi, your first thoughts on these numbers?
I think, Lata, clearly consumer durables have performed a lot weaker than what we were expecting. There were some sectors within consumer durables that I thought were going to lead to a slightly lower contraction in November than what we'd seen in October, particularly things like two-wheelers. But I guess we've had another month of fairly bad passenger vehicles, and also gems and jewelry continues to be a culprit as far as the consumer durable sector is concerned. So despite the base effect, this number has come in a lot worse than what we were expecting. So this definitely remains a concern. My guess is also that sugar, the issues that surrounded the sugar sector in October have had a much larger impact in November, because obviously the pace of crushing picks up as we go further into November and December. So
where would that come, Aditi? Where would sugar be accounted? Would it be in consumer non-durables? Okay.
Non-durables and basically in food products.
Well, that consumer non-durables is 2.5%. It's still a growth. But of course, there would be other products which made up. Samiran, to toss that same question to you, consumer goods as a whole contracting by 8.7%. Is this fresh bad news in terms of the economy not troughing out?
Yeah, I mean, this is what I was referring to initially, that we were thinking that some demand traction will come back in the second half of the fiscal. It appears from this data, and let's keep in mind that both October and November data are the data for the festive months, so a large part of consumption for the year as a whole happens in these 2 months. So if we see that the consumption growth is substantially lower in these 2 months, then the possibility is, and this is probably for certain sectors only, that festive times the discounts are lower. So possibly the consumption spending is getting spread to periods where there are more discounts available, a classic sign of pressure on the consumer. So if that's the case, then in January, February, when again some of the discount periods will come back, you might see some consumption growth coming back on track. But clearly, as of now, this is showing that the consumer is facing significant pressure from inflation and low income growth.
Okay, Samiran, I just wanted your thoughts on the fact that core sector growth has not correlated with the IIP growth that we've seen for many months now, or maybe at least a couple of months. And that was evident this time round as well, because the core sector came in at a growth of 1.7%, leading to optimism for IIP this month. And that comes in at a deep contraction of 2.1%.
Yeah, absolutely. I think that's a very important point, that apart from the consumption data, the rest of the IIP data looks reasonably good. It is showing that some activity is happening, particularly on
electricity.
The capital goods sector. The electricity production is good. Intermediate goods is good. So I would not say that this IIP data is particularly as negative as the headline suggests, because you will not get every month a 21% decline in consumer durables. And if that's the case, then possibly we'll see some recovery in the months ahead. I would tend to believe that some of the elements of the IIP is showing some traction, but unfortunately the consumer goods, which is a lagging indicator, is dragging the whole series down.
Okay, I'll come back to you for what that means for the Reserve Bank, but first to Aditi to take a jab at what she expects from the Reserve Bank now that overall the industrial output is indicating that growth should, if anything, be disinflationary.
Well, I think definitely. I mean, all indications are that both the CPI and the WPI are going to ease in December compared to the data that we had for the previous month, which was a sharp spike. Of course, there is some debate right now on how much that deceleration is going to be on the inflation side, and I think largely that's going to have to do with really what was a pan-India reduction in correction in vegetable prices. Obviously, we get some indications more so for the metros. That's what sort of is in our minds. But really, a pan-India correction is what we are going to get to see in the data on Monday and Wednesday. All said and done, I mean, we are looking at both the CPI and the WPI coming off the highs in November. And that put together with this data, I think we're looking at a pause in the policy later this month.
Okay, Samiran, since it is a consumption growth that has been so severely impacted and looks like some of the supply side responses have been set right, would it be a case that the Reserve Bank will have even more reason to believe that there is no need to squeeze out demand anymore? It is just crying out to say that demand is all but dead.
Yes, to the extent that you trust the quality of the IIP data, the hypothesis that you are forwarding is a quite reasonable hypothesis. We haven't seen this kind of demand destruction on the consumer side for a while. And not just here, if you think of something like a demand for diesel, demand for petrol, they are also showing a significant contraction in this particular phase. So from that perspective, I would say that there is some merit in letting the lag of monetary policy play through and wait to see how the market...
Saviran, would it not be that of all the inputs into the IIP, it is the consumer goods that is a little more robust because we get constant data on consumer goods?
Well, consumer durables, the basket that is there in IIP is a little suspect that whether that correctly reflects the consumer pattern or not, consumption pattern or not. And on consumer non-durable side, I think there is some data quality issues, particularly on a kind of timely basis, whether the data comes in or not. It depends on several ministries providing data to CSO. So there are some data issues clearly, but as long as we can trust that overall trend, I would tend to think that this is a lead indicator. Plus, let's also ponder on the point that a lot of us were anticipating that come October, November, rural demand will pick up because of good harvest and higher wages. It seems that, and there are now anecdotal evidence from different companies also, that there is no significant uptick in rural demand. And that was one of the drivers that we were considering for the second half higher growth. It seems that that's going to be a disappointment as well.